Hey guys, super happy to be here once again. And today I'm very, very excited because the last time that we have spoken and decided to schedule that recording session was very, very long while ago. And I'm very excited because the story and the experiences that we're going to hear today is going to be a very, very, very interesting and very comprehensive. And I think that we will be able to derive some clear and concrete values and notes out of that conversation. And I am very happy and pleased to feature you, Carl. It's a pleasure to have you here on our show, the Blushing Quants. Now, before we start, I would like to ask you, how are you today?
I'm great, actually. It's about the first day in 3 months that it hasn't rained here in England, so enjoying that.
Yeah, congratulations. I'm here in Tel Aviv. Like, it's hot. I have my AC's on 24, and it's freezing as hell here in my room. Otherwise, I would be melting out of heat. So I don't
Yeah,
really, have some relation to
I
that
know the
feeling.
feeling.
Yeah,
Uh,
yeah, but it's funny. It's funny that the differentiation like between the weather and the states that we're actually living in. Um, and yeah, before we start, I would love if you can tell the audience a little bit about yourself, about your background, and then we'll dive deep from there.
sure. So just in brief, I guess I wound up working in the city a little bit by accident. Originally, I studied physics and maths at Imperial and Oxford, and I didn't really know what I wanted to do. Um, I worked at Goldman Sachs under Sandy
But that's a very
Rattray.
reliable background. That's a very
Well,
reliable background
it's a
out
good
there.
start, but it's a good start.
It's a
But I think,
great start.
we're now in an age where it's very easy to say, oh, we just go into tech, or at least we were until about 6, 12 months ago. You just go into tech or you work in data science. But I think, back then physics was very much an academic subject, so it wasn't obvious. And we also lived in a world where you could do anything. Like, look at Germany. Angela Merkel was the Chancellor of Germany. So it's literally you could become a journalist or an investment banker or an accountant or a lawyer. And anyway, so I enjoyed my time at Goldman's, but I turned down my offer because I thought I wanted to be an investment banker. So I joined DLJ, then very briefly Credit Suisse about 3 weeks after I started, way back in the late 2000s. So it's just around the time of the tech bubble bursting. So I was in that for about 8 months, and then thankfully released because investment banking was not a lot of fun. And I wound up in the hedge fund world. So I wound up working for a top 10 Euro hedge ranked hedge fund, managing about 500 million euros. And it's a really fantastic learning experience, but it was very much the sort of peak of hedge funds, or very much a period where hedge funds were incredibly hot and doing incredibly well. And I was advised that I should leave and to launch my own fund. So I tried to do that and doubled my money, but couldn't raise capital at that point, and then ultimately joined a startup fund called Cork Street Capital, which had a couple of very experienced industry professionals, Prashant Bayani, who'd spent 9 years at GSAM as an ED, so GSAM is Goldman Sachs Asset Management, and Casper Lund, who had been at Avenue Capital, sitting next to, I think it was Chelsea Clinton was on the desk behind him. So they were very prestigious credit-based hedge fund. Before that, he'd been a sell-side analyst at Morgan Stanley. Um, and the GFC was just a very difficult but incredible learning environment for anyone in finance. So I did my 2.5 years there, and then we decided that the fund wasn't meeting the very high expectations that had been presented to investors. So it was down about, I think, 12%, 13%. So that
Yeah,
shut, and yep.
I
Mhm.
would like to ask you a question. You have
Sure.
mentioned that the fund was shut down because it wasn't really able to answer the needs of investors, and I would like to
Sure.
stop and to ask you what really happened there? Like how does the fund understand that it cannot deliver what it aims to deliver, and what was the gap in between what was presented initially to those investors and what
Sure.
actually happened in
Yeah.
reality.
So look, I mean, the idea of hedge funds is that they're supposed to generate consistent risk-adjusted returns in any market. And usually the hurdle for that is around about a Sharpe ratio of two, maybe 1.5 after costs. And in return for that, you receive, 2 and 20, or used to receive 2% of the AUM every year in fees plus 20% of outperformance of a high watermark. And obviously, we got off to a good start. We had some new money coming in. I don't think I could say who it was. But we had $100 million seeded by Protégé Partners. Goldman's were our prime broker, so we were, really, we were on a kind of hot list of funds to watch. And we launched. I think it was the 1st of September, or maybe it was the 30th. And we already had a few, by December, you could already see some strange things happening in markets. There was some sort of pre-earthquake, rumbles. And, when you look at the history of, what was actually happening in markets, you could already see that there were warning signs in fundamentals like big credit buildups and funny things happening in the credit markets. But, we are very much a fundamental equity research shop. And, we were so enthused and such believers in what we were doing and rightly so in my opinion that we would actually write letter when we met a company we would always write a thank you letter after meeting management. We tried to go the extra mile to really build those relationships. So what went wrong, I think, when you look back, October 2008, when the bottom started to fall out of markets, there was a period of about 6 months where no one really knew what earnings were going to be in the next year. How did you value a company? And so people were looking at price to book and metrics like that. And price to book is actually quite a good metric. I can tell you why if you like. It's proportional to return. It's basically proportional to PE if ROE is fixed. It's just mathematically that they're related by ROE. So PB is actually a sensible starting point. But if you everyone, for many years have been focused on, free cash flows and on earnings and on those sorts of fundamentals, which change with the economic cycle. And we were in an environment where, I think George W. Bush said, this sucker could go down. That was his technical assessment of how serious the situation was in the aftermath of, the Lehman bailout. So nobody knew. And I think, I've spoken, I can't give the names, but I've spoken to at least one person at one of the most successful hedge funds, founder, one of the most successful hedge funds in London. And, he told me they just moved to cash. And that's what we should have done. I mean, we reduced our exposures, but we should have just, cut the portfolio and said, we don't put our hands up in the end. So we don't actually know what we're doing at this point. So that's what they did. And then they started redeploying capital from around May or June. And I think they wound up sort of 13%. Because as you may remember, I don't know, you may be a bit young. Um, the response of the authorities was, of course, to reflate all the asset prices, which they did incredibly well
Mhm.
under Ben Bernanke. But we didn't know, we didn't have the policy playback book, we didn't have the macro background, we didn't know that that was going to happen. And that since 2008 has become a bit of a sort of playbook that they call it the Bernanke put, that whenever there's a sell-off in markets, the central bank will then ease, pump liquidity back into the markets, causing assets, collateral on the balance sheet to go back up and removing the potential debt problems in the banking system. That's basically what the dynamic is. Does that
You
make
know,
sense? Am I losing you
yeah,
a bit?
I
Hmm?
was listening to the entire story and I
Yeah.
thought to myself and I'm still thinking to myself, hey, you were spayed with one of the most successful one of the most with the founders of one of the most successful hedge funds in London, and back then he was telling you, yeah,
Oh, this was like
we
two
go to
years later.
cash.
So he was by that point. I think they were managing several billion. They were, already famous. But this was, probably I met up with them around about the time a year after they'd launched. So they were still pretty small at that point. Um, yeah.
Brilliant. It doesn't really matter, but I thought to myself about the adaptive capability of a hedge fund to move and to like succeed the struggle of different regimes and understanding underlying regimes and what actually causes their positions and influences and even though gravitate their positions in relation to their portfolio. And I imagine
Yeah,
to myself, hey, what if they have they had a system that could enable them to actually understand the power of the actual impacts their positions in relation to their portfolio and understand their portfolio and understand their circumstances and having
sure.
a proper stress test in VARs to understand all the relations. And I think that it's one of the most significant thing that a regular PM or a regular founder of a hedge fund would have to have nowadays because the market gets to be
Absolutely,
much
absolutely.
more efficient and much more efficient. And you're developing a product which we will speak about later on in the recording session. But yeah, let's go back.
Exactly.
Let's go back. Yeah. Let's go
Yeah.
backward onto your introduction.
Mhm.
And yeah, I would love to hear more about your story.
Sure. So look, I think let me just sort of finish a little bit more to that. So I think, we were long-term buy and hold investors, huge Buffett fans, and that was a tried and tested approach, and we kind of got basically kicked in the ass by macro. That's what happened then, and I think that is something that has become increasingly dominant in markets because of this sort of deleveraging environment that we've had since the GFC. And exactly as you say, this led me to I started to read systematic research in the aftermath of the GFC after Cork Street um, had closed its doors, thinking about, what we could have done better, what we should have done, how we should have responded. Because, I'd never studied the actual evidence. I'd kind of fallen into hedge funds and then been a believer, but never actually been able to backtest these ideas. And as a trained scientist, it seemed obvious to me that actually, if you have a hypothesis, you should backtest it. And of course, the people I worked with had read a lot of quant research and things from sell side and read probably some studies themselves, but I hadn't. So this was a great opportunity for me to study all of that. And what I found was that there was actually reams of really interesting research on, of course, what we now call factors, equity market anomalies. But they were always individual factors rather than the combination of factors. And that makes sense
Yeah.
from a scientific perspective, but it's, if you like, the wrong way around because Buffett, etc., have gone they started with the causal fundamental idea of what makes a quality company and why the fundamentals should allow it to outperform, provided it's undervalued or that's
Yeah.
not properly appreciated. Whereas all the physics people will say, well, here is a load of data. How can we find the signal from the data? Well, it looks normally distributed if you look at the log of returns. And so it looks random. And so that basically informed thinking about finance.
And
And then you got momentum. And we've sort of gradually triangulated on fundamental on quality as a factor and on the sort of systematic fundamental approach. Yeah.
I'm really intrigued about what you have just shared because you told me that with first of all, if you have an hypothesis, you're supposed to test it rigorously enough in order to derive a signal. And you say that people with physics background enables to extract. I'm just trying to reverse engineer what you have just said and they're able not just to derive a proper signal, but they're able to derive like a um, mathematical modeling for that signal. If I might use that if I might use that term as well.
Oh, look, I mean,
Um,
they will have come in and said, here's a data set. What we want to do is forecast future returns, and we want to optimize on future returns, i.e., we want to make the returns that we can generate as high as possible. So, what you would do, the first thing you do is plot the distribution of the data. So, you plot the distribution of returns. It's very common to use logs for these sorts of things. So, they would then plot the log distribution of log returns, and what they would see is a very nice normal distribution. And a normal distribution essentially is, a random. It's a normal statistical distribution that you would see for a random process in nature. And they then would have said, okay, so the stock market is random. And that's the starting point. And then, of course, over time, as they plotted different cross sections of that data, They then discovered things like the value anomaly, which is what they called it. And actually, the momentum anomaly came first, and then the high and low beta anomaly. And so they came up with what they call equity market anomalies. But they came at it with this initial assumption that the market was essentially perfectly efficient. That also
So
came from neoclassical
actually
economics. But
extracting those anomalies, sorry to interrupt. So actually extracting those anomalies is actually is their force or a brute force methodology to understand how that specific asset class
it's missing
behaves.
causation. It's missing causation. So, if you, yeah, there are different approaches. But look, if you're going to have a full theory of anything in science, you have to also establish causation. You can't just data mine signals and then say this is how things actually are. So
And how do you
Buffett,
articulate that
Ben
causation?
Graham,
That
Be-
causation?
sorry, I missed that.
How do you articulate that causation?
How do you so that's a really complicated technical problem, and I have to come back to you on that one. But that is it's a high bar. Um, so So look, you have these two schools of thought. That's what I'm essentially trying to present to you. The first one is the Ben Grahams and the Warren Buffetts of this world, um,
Oh,
who have published extensively on their theories of or hypotheses of how you should go about valuing companies. And then, as I say, you've got the quant camp, which has come from a purely scientific approach. And of course, markets, the economy is a complex dynamical system, so therefore so are markets, which means they're incredibly difficult to model and they're also incredibly noisy. And so, in my opinion, those approaches need to unify. But for decades, you had the two different camps, neither of which trust or believe in one another. So the Buffett fundamental guys, typically accounting people, MBAs in the US, will say that it's all about business, it's about relationships. The numbers are helpful, but it's really about getting in and understanding in detail and being very research focused. The quants will say it's a complex dynamical system, huge amounts of data, very noisy. It looks random. If we apply the scientific method, this is how we go. And I think that to unify those two worlds, you've got the causation coming from fundamentals and quality, and you've got the scientific side, which is necessary and because you should apply a scientific method really to any kind of decision making. And those two things are being unified. Now, here's a point that glues those two statements together, which I haven't made. And that is that when you build a portfolio with like 20 stocks or whatever it is, 20 plus, all of the research effort or the bulk of it is diversified away. So you wind up exposed essentially to quant signals. So the glue that means that, so portfolio construction is a
common
quant problem.
denominator. The research was made all across all of those assets. If I'm not misleading here, the discussion,
Yes.
correct?
Yeah. So you research an individual stock position, you say, oh, I love, Swedish Match. I want that in my portfolio and it's going to get a 10% position. That's the sort of way that you would think about it as a fundamental investor. You might look at the beta and how it's traded on Bloomberg. But you say, okay, that's my conviction. And maybe I have a catalyst, which I think is 6 months to 2 years down the line. But on the quant side, you wouldn't look at that at all. I mean, you would look at the betas as part of a sort of multi-factor quant problem and you would optimize based on your mathematical modeling. And a lot of those processes didn't really include the sort of fundamental quality based analysis that the fundamental side use. And so that's what the unification that's been taking place since 2008 has actually been, that's what's been happening in quant space. If you were very cynical, you say that a lot of these quant shops were momentum houses and they did incredibly well. But actually, equities, because it's such a complicated and diverse asset class, in many ways, the fate of equity markets is a function of what's happening with interest rates, bond yields, input costs, e.g., commodities, and exchange rates, particularly for exporters. Because of that, equities have a comparatively weaker momentum signal. So these guys are making fortunes for themselves running strategies based on commodities and bond in the bond markets, government bonds and things like that. And then after 2008, a lot of those momentum strategies crashed. really badly. And these guys, putting it cynically, they needed to diversify their business. They needed to provide a reason for their assets to stay put. And so they moved into equities. And so since then, we've had this big growth in systematic equity investing. And and here we are today. So I think if you go back, the quality minus junk paper by AQR, which is a famous paper in the quant space, was kind of a turning point. That came out in about 2013 or 2012. And since that time, that kind of laid out the foundation for a lot of systematic quant funds who've then built on that. Um, and yeah, but there was a really interesting paper published in by a famous academic called Sloan in 2017. And this was just in the aftermath of smart beta. And smart beta, if you may remember, was a lot of people say it was a fad, but it was taking these sort of equity anomalies that I mentioned earlier and making them into lower cost ETF products, exchange tradable funds. So an easy way for the public and funds to get exposure to these factors. And that didn't do very well. The thinking is that basically, because so many people were doing it, the factors became completely arbitraged away. But this paper by Sloan was published talking about the resurgence of fundamentals. Because although I've just talked about how equity funds had been moving in the direction of using quality again, and that led partly to smart beta. There was nonetheless a big momentum component again since 2008 because of all of the Bernanke put activities that we saw. Whenever the economy things started to go down, you suddenly had a new influx of liquidity via QE and other central bank policies. So um, we're just on the cusp, I think, of a widespread acceptance that the quality, and you also had the quality factor included in the Farmer French five-factor model I think that was 2014, 15, I forget the exact date. So we're moving in the right direction of unifying the idea that the quant approach of perfectly efficient markets was in fact not quite the right model and unifying that with quality. So Sloan published this paper, and then of course we got COVID. And as you know, COVID required a massive injection of capital. We saw a huge reflation in the economy, a resurgence of inflation, which people have been calling for many years and had never materialized. Um, and then we got higher interest rates, and then actually a lot of the fundamental strategies really started to do well again because you had the poorer companies, the junk companies, really suffering with the higher interest rates, particularly if they were leveraged. And so I think we're now back, or we soon will be back in the environment where fundamentals matter. But it's a very momentum-driven market ever since COVID because of
It's
liquidity
it's
and
it's
yeah,
it's very interesting to hear the story of the involvement of the markets because you were speaking about what happened how like the liquidity
that was a
injection
long yeah.
again.
That was a lot. Sorry, that was a rather a long
No, 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 no.
monologue
It
there.
was it was
Apologies.
perfect. It was
Mm.
perfect because I think it was a very self-explanatory explanation about what actually happened, and you have actually outlined everything. And for me, the involvement of the events really really catches my interest and made me wonder. Hey, okay, now we know all these certain occasions that really influence the markets, and back then when the liquidity injection really happened. Then, like the deployment of momentum strategies got ruined, and you would have to repair those strategies again because the market regime itself is like nothing in common with the previous regime, and that understanding of what actually happened and what actually happened before really enables quantitative researchers and you have mentioned those econometric magicians like Warren Buffett and Benjamin Graham, and obviously we have multiple of them over the years
Yes.
and that confluence like in the common denominator who actually that actually like congregate those two into one articulation of a trading strategy or a trading approach might be might be a much more um, I would use the word robust approach to tackle the markets because you cannot do it without the understanding of what actually happens. And for understanding what actually happens, let me know if you agree with me, Carl, or not. You would have to understand the situation itself. And understanding the situation itself nowadays is pretty much very easy. You have the technologies in your hand, and I'm speaking and I'm referring to those language models that we have. But understanding the real cause and how it actually influences your portfolio makes everything much harder, and it will always be that. And it will always be that way. And I would like to ask you, as of a very experienced guy in the markets who knows how the internal processes actually happening, I would like to ask you, how would you actually take a market evolvement, and how do you break it down onto understanding, okay, how it actually influences my portfolio, how it actually influences my positions, how I need to actually evolve myself and evolve my perspective onto the next completely different regime that actually takes apart right now.
So I think, I was trying to say that you have the two schools of thought, and they were almost unified. And Sloane's paper was kind of the sign that that was about to happen. And then we got COVID, and because of all the liquidity, we've now had massive momentum, and people have there are now two schools of thought. One is that machine learning, in particular, has made markets much more efficient, and the other school of
Going
thought
to
is
speak about
actually
that one as well.
and the other school of thought is my own, which is actually, we actually have what usually happens when monetary the monetary environment is monetary policy is far too easy for a very long time. And I'm not saying that it was the wrong thing to do. I'm just saying that there were costs associated with the post GFC and then post COVID environment. Um, one of the costs of that is actually a worsening of the allocation of capital, and there are different I'll come back to that perhaps later. There are different ways that you can look at whether capital is being efficiently allocated or not. One of them is zombification. So there's a fantastic paper by the Bank of International Settlements.
Zombification?
Zombification. So part of capitalism is you need to have creative destruction. So it's not just about providing financing for good
Destruction of
ideas,
what?
of bad companies. So frauds, marketing Ponzi schemes, ideas that don't really work, or industries that perhaps have passed their sell by date, like, the automotive industry, where it gets bailed out whenever there's a downturn. That's clearly an industry that's very mature. Margins are now very low. There's not much innovation in the core building of the autos. Innovations happening in adjacent technologies. You mentioned AI, self-driving vehicles, and all these things but the average car company has been very slow to adopt those technologies. You just look at EVs, for example. It took Musk I mean, that was always going to happen, but Musk accelerated the adoption of electric vehicles. So I actually believe, and so does Airshinists. He might just be talking his own book, of course, and I might be talking mine. But I genuinely believe that markets are less efficient than they've been in, 15, 20 years. Because when you're training these models, you're training them on momentum factors and things that are a function of the current regime that we're in, which is a function of this very easy monetary policy. And so I think that what I'm trying to say is that it's a bit like, general relativity in physics and quantum mechanics. You have two models that disagree with each other and that haven't been unified. And I think in finance, that's going to
And
happen.
let me just
Yeah.
interrupt your explanation because you have touched a
Yes.
very interesting point that I would like to furthermore that discussion.
Mhm.
And you have said there's a physics model and a mechanics model that actually unable to communicate in between each other, and they're completely misaligned with their results.
Yes.
And I would like to ask you, because
It's an
you
analogy.
made,
Yeah.
yeah, it is an analogy, but yeah, I would like to ask you, um, for from your perspective, and obviously you understand how the markets are actually evolved together, and you have a decent understanding of those models as well that you're actually trying to starting to describe here. I would like to ask you how do those all three components actually compound or and cover it into one or an understanding of what actually happens in the market.
Okay, so that's a very broad question, but I think you're asking,
That,
you know,
that's a
ba
that's a very broad one, but I think that if you're actually taking a hypothetical market shift and you're
yeah,
actually trying to understand the underlying, I don't know, the underlying forces from the physics model that you're actually presenting here, which we need to discuss about that one, and the mechanics model, understanding the regime itself, like the new regime and how the market evolved. That's like the combination of all the three, which is like the art of understanding the market, and both the models actually enables you to understand the new regime. And I would like to ask you how the regime is actually changed, and how do you understand the new regime, and what are the models that you're actually
okay.
trying to understand the regime with.
Okay, so just very simply, I think that we are in a regime where monetary policy is still too easy. And I think that that's because there's still a huge amount of debt in the system. And ultimately, there are only two ways to correct this problem of having too much debt in the system. The first one is to essentially allow the bubble to deflate. And that won't happen. It's not possible. And the second one is to inflate away the debt, which is something that's happened many times before in history. And the last time we had this was after the Second World War, where you had these huge total debt to GDP figures after financing that, global war. And there was no way you could grow your way out of it, even though there was a huge amount of reconstruction and so on. So essentially, we had capital controls introduced, and you had the debt inflated away over 20, 30 years. And I'm not saying that that's what's going to happen this time, but I'm saying that I think we're going to have higher inflation with different regimes in between over the next sort of 20, 30 years. And there are other sources of inflation as well. So I think that's unavoidable. Usually, inflation means you're going to have higher interest rates. So if we're going to have higher interest rates, then that is going to be bad for the very bad, the weak companies like the zombie companies that I mentioned. They will go out of business in many cases. And so I think that the outlook for stock picking, for fundamental systematic investing, like what I'm trying to do systematically, what Warren Buffett did back in his day, is the outlook is actually quite good. Um, the outlook might be better in other asset classes like commodities because things that are in fixed supply, where there is a fundamental and growing demand, as there is for many commodities, the outlook for those is pretty good as well. But the way I can justify why I think equities will actually stop picking this buying high quality companies and shorting low quality companies, why I think that will do well, comes from two sources. The first source is a paper by Man Group, and they have access to CompuStat, which gives you fundamental data back to 1955. And they were able to essentially backtest lots of different strategies across every asset class. And they found that this quality minus junk approach that I mentioned earlier from AQR's paper, which is the simple building block for building this kind of strategy, uh, generated real positive returns as a strategy in the 1970s. So sorry, that was the key point. The inflationary 1970s was the last time that we really had significant inflation in our economies. So it makes sense to look at what strategies performed in that environment. And QMJ is which is like a Buffett style buying quality companies and shorting junk did well, generated real returns about 3% per annum, I think. So it's low, but remember that it's still a positive return in an environment which is designed to try and claw your money back from you. And it's Warren Buffett said that during that decade they struggled to generate real returns, which makes sense. So that the best you can do is try and hang on to your wealth, diversify, and make a little bit of extra if what I'm saying is our outlook. Now, other people say AI is going to create this massive, AI, in renewables and particularly fusion and other uh, innovations are going to power the growth in our economy. And, we're going to see that's going to be hugely deflationary. We're going to get very rich, but much more polarized. I don't personally have that view, but it's too early to say. Most of the evidence I've seen suggests that's all pie in the sky, jam tomorrow. Um, but it's the nature of these things that you can never actually see what the economics are going to look like until you're further down the line. So I love AI technology in particular, but I think it's a
Who
massive
doesn't?
bubble. I think it's a massive bubble. So it's like the tech bubble again, and it's been blown up by,
Yes, it is. Yes, it is. Yes, it is. Because look, I was speaking to a very good friend of mine earlier this morning, and he shared with me we have spoken about like the bitter lesson. I was speaking about with my previous guest about about the bitter lesson as well. And we have spoken about how like the evolvement of the AI era will actually t take part with those applications of new technology and understanding the limitations and the capabilities of each and every single one of those technologies and how it will actually impact. Now we have to understand like we if you have just spoken about like the rationale of understanding the evolvement itself of the market, um, we have discovered that like the new capability of large language models, if there is a different usage, will impact if you're actually presenting it as a bubble. Uh, I would say that hey, now there is a new flush of large language models, and it will change dramatically the usage of data centers and the usage of GPUs, and it will demand much less computational efficiency than it is right now because this is the bottleneck. And
yeah.
will actually pop the bubble you're speaking right now, that you're speaking about right now.
So this is obviously not my area of expertise, but my understanding is that I agree with some of what you've said there. I think the bottleneck is actually resources. It's the
Yeah,
input
the
commodities.
bottleneck nowadays is a is a resource problem now. Look, we're not here to discuss about the bottlenecks
No.
in today's economies. Or to analyze how do those bottlenecks will occur.
Yeah.
What I'm just trying to say here is without understanding the core the fundamentals of how the actual bubble will be popped away,
Yes.
you will not be able um, to move yourself and to adapt yourself properly onto the next regime. And I think that fluctuation will impact your portfolio necessarily if you don't really understand the rationale behind those things, which is exactly the entire discussion that we're actually having, which is understanding what actually happens underneath the radar, how it actually impacts myself and my portfolio and the models
Sure.
themselves.
So my approach is entirely, based on return on invested capital, CFROI, those sorts of
So it's
approaches. That's
completely
the product
changed.
I've built. So it won't check. What will happen is that if the economics of AI companies actually is proven to be lucrative, sufficiently lucrative, what will happen is the return on invested capital will rise above its cost of capital. And at that point, they will come into my investment system and be bought. And I saw this with Amazon. I forget the exact year, but Amazon was one of the, tech survivors that where Bezos built a real business. And, I think it was maybe 2000 and 2005, 2006, it started coming into my systematic portfolios. But before that, it was not generating the returns that it needed to. And of course, actually, that was a really good entry point for the stock. It was when it became investable, that was when you wanted to own it, not when it was still like a needle in the haystack, where you couldn't really say you needed a degree of belief. It was when it was showing the actual economics. It had proved them, validated it, it was generating the cash flows, the levels of investment were not obscene. And I think that's the issue with AI. The technology is amazing. It's here to stay. I'm loving Opus 4.6 at the moment. I'm just blown away by that model. Absolutely. ChatGPT goodbye. I think OpenAI is finished, but we'll see what the next model they produce is like. But I love the tech, but every dog has its price. And I think there's maybe the dynamic at the moment is a lot of these companies are raising huge amounts of capital. And if you just use a thought experiment, if you raise $1 trillion, say, and then you heavily subsidize, someone gives you $1 trillion, you're then burning this cash on incredibly capital intensive, expensive energy, consuming data centers, and you subsidize massively all of your users. You can keep doing that until you can't. And I think that's the dynamic at the moment. So it's heavily subsidized. The real cost of this technology, I don't know how much higher it is, whether it's 10 times what we're paying. And I wouldn't pay, much as I love Opus, I would not pay £1,000 a month for it. I can't afford it, which is so the return on investor capital on this tech may very well be below its cost of capital. I think then you'll see consolidation, companies going bust, and at some point it will, the market will arrive at the right valuation for the tech, and at that point, that's the time to invest. Probably there'll be a behavioral element where everyone then hates all of those companies, but the ones that remain have have actually managed to make it into a real business rather than just a technological disruption. Those ones could turn out to be very good, very profitable investments. Like Microsoft and Apple were in they still are perhaps, but were in their day. They were very early into this tag. And the way I would think about, valuing an AI company as a fund, putting my fundamental hat on, is you essentially have two business units. Like think about Google. You've got the advertising business, which is incredibly profitable, an amazing business. And then you've got the very speculative, AI Gemini business. And, the discount rate you should put on
Speculative business.
is like maybe 20-30% on the AI part and maybe 8 to 10% on the high quality bit. And don't forget, advertising is very cyclical. It's just that because we've not had a real recession, we've not been allowed to have a proper recession since 2008 because of the trying to keep everything afloat with the debts in the banking system to delever. Um, People have forgotten that happens. Yeah, they just think Google's there, and everyone just spends and everyone's employed. And I think we're about to remember that that's not how the economy works, or certainly outside the US. But yeah, we don't want to talk about politics, and
Yeah.
because I think that's another strand to what's happening in markets. It's this thing called the Triffin dilemma, which essentially is a structural.
Griffin dilemma.
Yeah, it's an empirical observation that the world reserve currency issuer has to run with a deficit. So they essentially, the way it's phrased is they provide the liquidity for the rest of the world. What that really means is there's a wealth outflow from at the moment the United States, which has led to a big public debt position and a growing deficit as China has obviously been growing since it joined the WTO in particular. Um, and that was financed initially at least by outflows from the US. And we've come to the point where you usually would have a big reset. And the last time we had that was 1985 with this thing called the Plaza Accord. And before that, you had, remember, the Bretton Woods, and you had the Nixon shock, which actually was clear. I believe it began in the late 60s, but the actual date at which you had the Nixon shock where the Bretton Woods regime finished, where trading partners of the US could no longer convert their dollars that they received from trade into gold. That happened in 1971. Um, and so I think there's a structural problem in the monetary system, and that leads to, growing deficits, capital misallocation, capital being too easy, and then a big reset, which is what I think Donald Trump is or his team anyway, the intellectual idea behind what they're doing is related to that. But
I
anyway, that's another topic, and I'm going off
Yeah, yeah,
piste with that, I think.
completely. Completely. And I would like to before we're going to speak about like I'm a big believer of understanding what you're doing currently
Yes.
in order to actually extract how you envision the market. And
Sure.
before we started the recording, you said that you're a great believer of what you're actually doing,
Yeah,
which is very fascinating. And I think that the entire discussion of how market evolved and everything that we have spoken about previously um, is actually I think it has direct implications of what you're doing currently, which I would love to discuss about in
sure.
detail if possible.
Yeah,
And I think it will actually represent your proposition and your belief in the financial markets nowadays. So yeah.
sure. So what all of this that we've just discussed has led me to do is really to build my own investment analytics system, which attempts to identify the companies, the highest quality companies that are growing in a sustainable way from a business point of view, and within that universe of high quality companies, the ones that are the most attractive investment proposition. So it combines essentially the fundamental approach of analysts being very focused on return on invested capital, CFROI in particular, and the quantitative evidence-based approach of trying to select between these companies in a systematic way. And that systematic way, of course, is backed by back tests, not just fundamental theory. Um, and so that led me to build this product, which I want it to be a full um, equity analytics product for really, I think for everybody, but at the moment it's an institutional based product. And the thinking is rather than because when you're building a fundamental model, what you typically will do is you'll type in all the numbers from the annual report, and then you'll try and put in some forecasts, and you'll speak to analysts in Wall Street or in London, and you'll speak to then you'll collate a list. You build your forecast, you'll collate a list of questions, and then you will have a call with the company management for half an hour, and you'll kind of stress test your ideas and try and like use a mosaic method, if you like, to by asking them lots of questions to build a really comprehensive view of a company and reflect that in your model. So that's the classic fundamental equity research approach. But
Mhm.
what really I think people should be doing is thinking about the economics of the business. So not saying, oh, margins are going to be 16.6% next year, and the working capital days are going to be 22. They should be thinking about what are the actual economics of this business division. Does that make sense? Is it should this the CFROI for this be 15%? Should it be 10%? They're talking about this exciting project. What is the likely trajectory of that project? Because that's where the economic value is going to be created. The government said this is the size of the addressable. Sorry, the company has said this is the size of the addressable market. They've said that this is maybe the capex they're going to spend. But what does that really, how does that compare with the past? Competitors in the same industry, across the market, competitors in other geographies. And I think if you really want to do forecasting properly, you should be focused on that. So you really need to understand the economics and the capex and the timing of those things. So that's like the asset life of each of those components of the business. And that's how you should go about your forecasting.
Now,
So
how do you see how do you see the go-to-market of that product now for nowadays portfolio managers?
So I think there are multiple I mean it's a complicated product. There are multiple value propositions. And I think the lowest hanging fruit one is simply look at the actual restatement of all of the historical data into this if you like CFROI return on investor capital framework, because that really gives you a much better view of how companies have actually been performing, because it's predominantly based on the actual cash flows generated by the company, because it addresses things that are expensed on an annual period rather than over the life of the company's projects. Um, it brings those back on the balance sheet. So it has a much more stable and realistic measure of the asset base. And you see this when you actually look at the analytics. You compare the ROE, ROA, ROIC, or even gross profits over assets, much more stable. once you've made the adjustments that my system makes. So it gives you a much clearer view of the actual underlying economics of the company. And within that, there are also lots of adjustments that I make.
And
One
how
of
do
those, yeah,
and how does the PM and how does the PM can leverage those underlying economics of a company
sure.
and actually derive a conclusion, or is just an enrichment of the understanding of what actually happens underneath the radar?
Yeah, so ROE is a really easy one, right? Because you get companies that have negative book values because they've done so many share buybacks. It's a very simple example. So if you were to look at the ROE of those companies, it could be like minus 600%. I think if you look at Starbucks, for example, that's an example of a company that for a number of years has had negative ROE. And that's an extreme. And if you look at ROIC, usually people calculate that as equity plus total debt. So if your equity value is negative or too low because of share buybacks, your actual capital base is going to be wrong. And there are many other adjustments. So all of those other metrics are flawed, whereas my metric is attempting to adjust for all of the accounting uh, inefficiencies or, because the reality is that accrual accounting is not designed for investment decision making. It's designed so that accountants can kick the tires of companies and make sure that they're not going to go bust, i.e., that their profits and that their cash flows are not going to go below zero for too long, given their debt obligations and obligations to other stakeholders. That is not the same as making an investment decision. When you make an investment decision, you want to earn returns that exceed your cost of capital. So that might be 8% or whatever. You do not want to invest in a company that's very risky and on your numbers is going to earn less than what you'd make by having your cash in the bank. So uh, that's part of the value for a PM is that actually being able to see what the real economics of a company are. But there are loads of
And how do
other
you extract and how
aspects
do you
too.
extract those and how do you extract those values? How do
Sure.
you actually how do you actually map the economics underneath the radar and provide it as a proposition to the manager on the side of the
Sure.
on the other side of the yeah.
Yeah, so I'm lucky that there's already, a number of other products out there that are extremely successful. Like I think the best known one is UBS Holt, where they charge $20,000 a seat or something like that. Um, but they're very high end. I think there's a huge number of family offices and high net worth investors, tech entrepreneurs who've maybe made a million or two and they are wondering how they should manage their assets and they don't necessarily, they know that their private banker is basically going to not do a very good job for them. So I think that whole market segment is not being properly addressed. Um, but in terms of the adjustments, I think you asked about that as well. So there are numerous adjustments to the asset base. The first thing is that you want to only have operating assets in the capital base in your calculation. So things like pension liabilities or pension assets, tax assets, those have to be stripped out and dealt with differently. Operating leases, they are now capitalized, but that's another mechanism by which company managements can smooth their numbers. Because if you capitalize an operating lease, is very sensitive to the capitalization rate you use. So we use a standardized approach. R&D is regarded as an investment, not an expense. So if you're an accountant, you say you're looking at earnings. So expensing R&D looks conservative, but in our world, where it's about the return on the capital base, if you capitalize R&D, then you're effectively multiplying the expense by five, or just as an example, and then it's going into the asset base. So if the returns on that R&D are not being earned, then the company is penalized by a lower return on invested capital. And some of the other adjustments involve, adding back, stock expenses to earnings, adjusting earnings. So something like 96% of EBITDA numbers out there now are adjusted, and that's what everyone uses in their models. And they include things like restructuring costs are stripped out, and you can apply various data science methodologies to adjust EBITDA and put those recurring non-exceptional costs back in. So the company's flattering their margins, flattering their earnings, by using these adjusted EBITDA numbers when actually those are operating costs. So we add those back into our model using data science and other many other adjustments. Depreciation policy is something a company can change, and they often do, particularly in economic downturns. So they reduce their depreciation costs, and you can see that when you see the asset life shoot the roof. So we adjust for all of that. We smooth because the economics of Starbucks, for example, doesn't change from one year to the next. It's still selling coffee, right? It's
Yeah.
fundamentally going to earn 10% a year. It's not going to go to 15% or 6%. It's going to continue with 10%. So our models will assume a smoothed and adjusted, um, more predictive asset life. And there are other things like you have to adjust for the market value of debt. You have to adjust for discontinued operations and M&A. Um, you have to adjust for just trying to think off the top of my head. There are others. I mean, there's an extensive shopping list of adjustments that really you should make to make as I say, the economics of the business model really stand out. And then, so that's the starting point. But you also can have forensic screens based on whether it looks as if aggressive accounting might be taking place. So that's, another addition. Um, and, going back to the operating assets and operating profit, EBITDA, adjusted EBITDA, in-house adjusted EBITDA, being in the numerator and denominator of the calculation. One of the things that I've been working on quite a lot recently is making sure that the right intangibles are actually in the asset base as well. So things like, goodwill, very simple. You just strip that out. That is an accounting figure. It's not an operating um, number. But, things like brands and customer relationships, those are actually things that money was invested in or spent on. So they should be in the asset base. Um, but other things like, long-term assets, like, the golf course that that has nothing to do with the operating model that a company may own, that shouldn't be in the operating assets. So there are an awful lot of adjustments that need to be made. And as I say, when you do that, you get a much more stable set of numbers that are then also much more predictive of the future numbers as well. So that forms a better basis of forecasting too. And if you're trying to do screening on companies based on whether they're likely to be under or overvalued, then having a good forecasting model before a human gets involved is quite an important starting point. Um, so those are a couple of the key obvious ones. But yeah, my dream is to build a complete end-to-end process. And one of the things I've been thinking about adding, not now, but once
Seems to
it's
be
mm,
that you're in the right path to do that.
yeah, I mean it's been a hell of a lot of work. I'll tell you that. But it's very exciting, and
It is.
it's so I
It
think
is.
that and I think there's also like there's an aspect, something I mentioned to you earlier when we last spoke, which is I think, people think about capitalism in the wrong way. I think capitalism has a PR problem. So I think capitalism is political, um, not a political construct. I mean, of course, it is to a degree, but it's about allocating capital efficiently to generate a return. And if you think about it, right, there's a component of our economy that is resource based. And if, we're like the economy is an energy system, really. I mean, everything we do requires us to expend energy. We get energy from food. It's an energy system with other aspects which are also important. And if we don't allocate enough capital to those productive, necessary, profitable uses in our society, then we will basically get poorer. And so I think we're in desperate need of actually advocating for capitalism for that, not the political side, which looks more and more like corporatism. But again, we're not going to talk about politics. Um,
Yeah.
so my toolkit essentially, hopefully, advocates for how it or will advocate for how important it is that we, as a country, we actually manage to generate our own returns that exceed the cost of capital. Because otherwise, we're all going to get poorer, and I think that we're not doing that. I think that the I'm probably not going to win this battle, but I'm going to try. Uh,
Yeah, and I would like look there is a diversification of products in that field, and obviously
yeah.
that field is very challenging. You know, all those very smart brains are actually allocated as a potential buyer for those products, and um, and I'm very cautious by saying that, you know, diving or we're going to that type of market is going to be very struggling. And I would like to ask you, how do you see yourself having a proper fit inside this market, which you already know you have sharks and big whales, you know, swimming in.
Oh, look, we'll see how hard it is. I mean, I haven't launched yet. I'm hoping to launch at the end of the month or maybe early next month, but
So
it's
congratulations.
soon. Thank you. I think I'm still talking to an institutional data provider who has invested a lot of time in me, and he wants me to launch an institutional only product. I want to launch, both, and so I might do something with FMP. I haven't agreed with them yet, but we had a conversation a while ago. So a cut down version for the general public and an institutional product a bit further out. Um, but I've recently done some work with a rival, I suppose. I mean, they've raised 3.5 million euros. They are led by the former head of Holt Research, really nice guy, Brian. They're great guys. Um, and I helped make some introductions to them, to really big guys who probably wouldn't deal with a small guy like me at this point. And the reception was very positive. So I think that I personally believe there's a real need, and there's definitely demand. So I think it's about having a product that people really enjoy using, because I think that's the problem I've always had, even with Holt. It's like there's a pressure to try and provide too much data on a page, too much information, and you have to have that available. But I think making it a pleasure to use and enabling people to focus on what's important is absolutely key. And I think the CFROI approach helps do that. But I think it's the way in which you actually enable people to interact with it that is going to be key to the success. And then we'll see. So um, I don't have
How
a
do you
yeah.
leverage? I was reviewing your the material previously, and I was watching that you're actually you know, having machine learning applications instead of your product. And I would like to ask you, how do you actually leverage machine learning in the process of actually
Sure.
of providing concrete data to those people, which seems to me be very mathematical rather than machine learning approach that is actually needed here. But I would like to ask you, how do you actually leverage it properly?
Sure. So there's two questions there. I think you hit the nail on the head, in the sense that a lot of machine learning algorithms are not easy to interpret. They're basically a black box. And, rightly so. Sometimes if they can hallucinate. And this is a problem that every form of AI machine learning has, as far as I'm aware. Um, but they also work, particularly at portfolio construction level, extremely well. So there's value add there. So if you actually want to build systematic portfolios, then you should use it, because it's a good tool for that, provided you use it properly. So in terms of how I go about it, I use it for forecasting, and that's already a product that works quite well. I have no time to do more work on it right now, but I have a research pipeline on it that I'm really actually very excited about. And there's a lot of academic research out there now on using machine learning for forecasting, which is quite compelling. And the way I use it is that I combine some of the predictors from the CFROI model, which are very similar to the predictors that Holt found worked well in their linear models that they used in their, or use probably, I don't know what they do now, in their product. So things like the CFROI level itself is a really fantastic predictor. And then there are a few others I won't tell you about that have come out, but they're all very fundamentally driven, which is reassuring. And what I did was with that is I actually started off with about 800 factors, and I whittled it down by repeated machine learning test runs. And I did it sensibly with, I basically only trained on 20% of the universe and tested on the other 80%. And I did various modifications to jumble up the data and make sure that you didn't have. It's been a while since I did this, but you can get autocorrelation between if you have things sequentially in time. So I've tried to avoid that kind of thing. And and I whittled that down to about, I think it was 20 or 30 fundamental factors. And I found that I then trained a separate model for every year. So I had about 16 or 17 years of data going back to 2005. I trained a separate machine learning model using the same predictors for every single year. And I looked at something called the Shapley score, which is the best way of measuring factor importance that you can use for a model like this. And I found that every year the six most important factors were the same out of all of the factors I used. And I also found that the ordering between them was generally the same. And there are a couple of years where, like COVID, you could see that I think it was COVID, you could see leverage became more of an important factor, which kind of makes sense. So you can sort of see some fundamental logic, which is kind of like an anecdotal confirm to it. And then for each of those years, I looked at the error associated with the forecasts. So I compared the error with the actual result the company produced, and I found generally okay results. But I think I don't want to give you a wrong number. I can't remember off the top of my head, but I think the error was maybe 10% or so. So as I say, I'm not entirely happy with it yet, but it worked well. It certainly wasn't destroying value, and I think it adds value. But the next incarnation, I'm very excited about because that will use things like macro predictors. It will use, industry specific predictors. So, like if you're looking at a copper mine or a gold mine, for example, or an oil producer, it makes sense that you would have the prices of those, maybe the lag prices too, because some of these companies hedge as predictors in your model. And similarly, other sectors like the consumer sector, there are metrics that you can use, like housing starts. It's quite a good early stage because employment data is usually late stage. So things like housing starts are quite good as a sort of early stage macro indicator of consumer health. And I just think pulling those into a forecasting model will be really had a lot of value. And there's a really interesting paper by someone called Eric Geisels, and I think it's Ball as well, possibly the famous Ball, I'm not sure. Ray Ball, I think he was. And that they basically combined analyst estimates with cross-sectional estimates and macro um, data in I think it was a Midas model, which is like a linear, it uses short-term interpolation to essentially approximate short-term relations between variables. And they found that that was way more predictive than analyst estimates, which are quite good. Um, by the way, so FY1, FY2 analyst estimates are generally pretty good forecasters. They're generally they have positive bias because analysts tend to be too bullish.
Mhm.
And
Yeah.
that's not the fault of analysts. That's because certainly in London, I don't know about the US, but in London, I speak to sell side all the time. And they are the mouthpiece of the CFO. So they speak to the company in some cases on a weekly basis, and the company will guide them as to what they're likely to produce. And if you're an
Oh.
analyst, you're not going to go against what the company's guiding unless you have a very, very strong case for doing so. If you really believe, cool.
So, Carl, just to circle back to our starting to the start of our conversation, we have spoken about you were a part of a very well established and a very wealthy family office in New York, and I would like to hear more of that about that experience. What it's like being sitting in family office, how a family office actually operates, and how those internal processes actually happening, and how do you actually invest or um, or trade the family's capital inside the markets, and how do you actually make the right diversification between all of
Sure.
those asset allocations that you're actually holding.
Sure. So I probably can't answer all of that, but I can give you a little bit of color on how I actually got to work there as well, which was
Brilliant.
I used to be an avid reader of I still do read it sometimes, Wesley Gray's Alpha Architect website. And one day there was an advertisement. Would you like to go and help build, design, and trade a new fundamental systematic equity fund at a New York-based family office? And I sent in like a huge, ridiculous pack, 150-page pack or something of all my thoughts on systematic investing. And like months passed and I thought nothing of it. And then I got an email from this guy and he's like, "Oh, hi, you sent your details in." I'm thinking, "Who's this?" And anyway, so I replied and he said, "Oh, can you talk tomorrow or something?" And I said, "Oh, yeah, sure." And it turned out it was this guy from like a multi-billionaire family office, a Jewish family, as I think I mentioned to you before, and very involved in Israel, but I can't give you any details beyond that. And very much part of the US establishment, friends of the Clintons, all the rest of it. And this was the grandson. And so I was like, "Oh, yeah, okay." And then, we had an initial chat and he said, who was my referee? And so I sent Dr. Frangelo Salvatorelli, who's head of research at Lansdowne Partners, a very experienced hedge fund manager. And so I think they had a call, and then he wanted me to speak to his brother, who was the CIO of an in-house hedge fund there. And so all of that stuff went really well. And then he was, "Okay, well, can we start in like a couple of months?" And then it turned out actually, so I wound up, it was October 2015. Um, I wound up actually being out in the States, visited a friend in San Fran, which is an amazing city. And then I went and stayed in the Harvard Club. And I was going to the office, which I can't tell you where it is, but not that far away, every day for a couple of weeks. And so I didn't really get to meet that many people there. I mean, I met the brother and I met his father, and I met someone who was helping out there. Um, and I think there was a lot of property business stuff going on. I could probably say that, but it was very professional. I mean, it wasn't in any way relaxed. Um, and I was just working largely. We actually almost teamed up with Wes Gray, and I don't know why we didn't, but I think we didn't we had access to the Credit Suisse Holt data set, and we didn't know initially that we were going to get that. So the idea was that Wes's team would help build the initial infrastructure, and then I would take over from there. But actually, because we got the whole Credit Suisse system access to all of the data, we didn't need that. Effectively, that part of the process had already been done. So I took that over, and I basically started to design a systematic fund based around quality minus junk, but using these Holt, CFROI metrics. And I'd already used Holt in previous the other hedge funds I worked for, but I've never actually really got stuck into the nitty gritty in the way that I had the opportunity to there. And so then after the 2 weeks, I worked remotely in London, and the other chap was supposed to come and join, but he joined, but it took him about a year to move to London. And we worked together. Then I was in London, like I think it was once a month or something like that, to build a bit of a relationship and meet in person and talk about prospects. But as I say, the the fund actually performed really well. I mean, it was up, I think, about 8%. And there were some initial trading teething errors, so probably lost, 60, 70 basis points, which is huge. But like this is where you develop your trading systems from bottom up. You're bound to have things like that happen. So I think the market was up 9%. There was like a reflation trade um, period happening in markets in that at that time, and I think it was 2017, and so it did well. When you looked at the sort of weekly correlations, there was negative correlation happening between strategy and the market. Sharp ratio was about 1.8 post costs. It all looked very good, but for some reason the family decided not to seed it. So then after that, I obviously thought I want to build my own fund, and I didn't have access to Holt, so I built standard factors and had pretty good backtest results, but not quite as good, and implemented some of my own ideas, and then here we are, built CFROI, and I also have my own fund proposition, which has done really well. I had a year where I can't probably mention them, but there was one of the world's leading equity book multi strategy firms basically gave me a 1 year data trial, and they didn't bite, but that was the first incarnation of the fund proposition, or maybe the second one. So it wasn't even using analyst estimates then; it was all based on historical with no forecasting. And now I'm talking to several potential seed investors. One looks very hot. I just need to get the final proposition to them. I was paper trading the strategy for a year. Um, it had a Sharpe ratio, did really well after the Trump tariffs were introduced because what happened there. So people, here's a bit of color for you. A lot of people say, oh, markets are just about momentum now. But what actually happened from sort of February till April, when Trump introduces tariffs, is that the really crappy companies collapsed and the high quality ones fell by less. So my strategy was up 30%. I kid you not. And it doesn't use a lot of leverage. I think the GAV was like, it was running with a net of 10 or 15%, and the GAV was about off the top of my head, I think it was about 150% or something like this, maybe less. So it was not levered. It was just you had a really sensible reaction to something that people probably should have seen coming to a degree. Um, and I'm not still paper trading it because I can't build all the other things I'm doing and run a hedge fund. And one of the things I learned whilst I was deploying risk management and other aspects that you have to have before you have a live trading strategy is that my beta hedging needed some further work. So if you I'm my strategy is essentially equity long short market neutral. And the idea is to invest like Buffett over the longer term, but you can also harvest these short-term market dislocations. You have to have risk management in place in order to protect yourself on the downside. And so you need to take the long-term view. You also want to um, have good risk management and try and make money out of that while you do it. So that's the philosophy um, behind it. So I'm working on a fully fledged beta hedging approach, which is looking very promising. And I would like to include things like the VIX as a sort of, it makes sense that when the market perceives greater periods of uncertainty, you should obviously reduce your exposure. It also makes sense when you have extreme levels in the VIX, that then becomes a fear indicator rather than a pure uncertainty indicator. So it makes sense that you would actually want to go long. So you probably want to cut your gross and increase your net in that kind of scenario. And it's those sorts of things that happen sometimes several times a year, depending on extreme, where you can actually harvest a bit more alpha. And but that's not the core of the strategy. It's just you hear a lot of people talk about stuff, and it's like they're stuck in the past. They don't embrace new technology. We've had or new evidence. We've had several fund managers who had fantastic in Britain who had fantastic 15-year tracks, and then the last 3 years they haven't changed at all, and they still own the same stocks, and they say they're
That's right.
wedded to the same
That's
positions.
that's a very frustrating reality.
But they should be trying to make themselves better. I'm not saying that Diageo or whatever is a bad investment or a bad company, but maybe it's not what you should be owning right now because you've got, in the US, you've got 4 or 5 thousand companies you can buy. Maybe if you've got a bigger fund, it's a smaller investable universe, but you've got hundreds of companies from which you can choose. And you've probably got, high quality companies, you've probably got 50 to 100. You don't have to pick that one just because you know it and you really like it and then stick with it. There are another, 49, 99, whatever it is, companies you could invest in. And,
Mhm.
so we have the technology to make better informed choices than just sticking to a process that's no longer working, even if it has the causation behind it.
That's
So,
that's very interesting. Now, Carl, a question before we go. In quick few sentences, I would like to
sure.
ask you, how and where do you envision yourself in the next a couple of years, let's say 2 years from now? And what do you think that will compound for the most within your journey as an entrepreneur nowadays?
Sure. So look, I mean, I'm launching my product in the next month, and that will probably be a soft launch where I will start putting out basically white papers and stock screens and talking about CFROI, return on invested capital, the sorts of adjustments, zombification, who are the zombies in today's market. There are loads of different interesting topics that one can talk about to drum up interest. At the same time, I'm going to be building my institutional level investment platform, or that's my plan. But I think that the just those screens, etc., I think will add enormous value. So on that side, that's the immediate future. In terms of the hedge fund, I'm due to get back to one of the seeders the next couple of weeks. I've got that going on as well. So I've got to finish my beta hedging strategy, which, as I say, is pretty promising. But I've got to get that nailed. And if they seed me, I guess that I have no idea, but it's up to about, I think it was 5
Yeah.
million. And then kind of so you build that, and after you've got a good year under your belt, you get more money. And maybe in 3 years, if I was managing 100 million, that would be a really great position to be in. I mean, maybe that's a bit rose tinted, and who knows what market's going to look like over the next 3 years. But I I think that that's reasonable, and back tests and looking at other people who have done this before. As I say, I think the outlook is quite positive, and I think when the market goes up, a lot of people get very rich. The hedge fund industry has had a really bad reputation in the past because people would launch a fund in, beginning of a bull market from some big brand investment bank. They'd charge the highest fees they could, and then they'd just have a levered punt on the market. And, between 2003, 2007, markets were up sort of 20, 30% every year. So people were basically becoming multi-millionaires off their clients' capital. And then when the tide went out, and it turned out, of course, they were just gamblers. Their clients were down, 40, 50%, in some cases more because of the leverage. And so these criminals basically retired rich, and their clients, swore never to touch a hedge fund again. And I think the industry has matured now, but because of all this liquidity and momentum, I bet that there are a few
For
more of
sure.
those people. Yeah, so I think if you can, as the environment gets harder, as I said earlier, with inflation, higher rates, but rates probably below the level of inflation to delever the economy over like maybe the next 20 years, that's a reasonable baseline outlook, I think. So strategies like mine will do quite well. I mean, it won't be like the roaring years, but there won't be so many that manage to do well. And so I think my outlook will then be quite positive. Um, but we'll see. I mean, considering how much work I've put into all of this, just, you see people starting at hedge funds, you think you definitely haven't done as much as I have. So if I don't feel ready after like 8 years of grinding, how can you feel ready after 6 months? Like to build a
Yeah,
proper
yeah, yeah.
equity factor model with 20 years of
That's
history to do it properly. I just there are a lot of people out there who are either deluded, or they learn at business school to put on a sharp suit and a cheesy grin, and it works in a bull market. I don't think it is going to work in what faces us coming now. um
well, the readiness level is obviously challenging. It's obviously challenging. You know, aspect nowadays. Um, and um, and I would like to close that conversation with one sentence that I have learned out of that conversation. I think that if you don't under like my code out of that conversation would be market involvement tends to be heavily due diligence, and if it's not heavily due diligence, you're unable to explore the rationale of the shift in the regime, and that's my key takeaway out of it. Obviously, speaking about your product, which I will you know, I will wish you best of luck and success
thank
with
you.
it. And I'm sure that you will highly succeed with your proposition. And
Thank you.
it was a pleasure to have you here on the podcast, and a very, very, very thoughtful agreement. Um,
Yeah, we could have
Uh,
gone
uh,
going for another 90 minutes, I feel.
Yeah, yeah,
Yeah,
we can go all around, and you know what? Let's do it on live. I would love to have a part B with you, and yeah. So this is a formal invitation for part B because I think we
great.
have a lot to cover and a lot to discuss.
But no politics, as long as we agree.
Yeah,
No
no,
politics.
we can discuss politics. Look, we can discuss politics, but offline. That
Yeah,
that
yeah,
that that that, that would be off air. I was mistaken
sure.
a bit, but yeah.
Yeah.
Thank you very much, Carl. Thank you very much. I'm very happy and very glad for the opportunity. And
Oh,
yeah,
thank you.
um,
It's a pleasure. Really great opportunity. Thank you very much for having me.
thank you. Okay, and thank you, Carl, again. And till next time. Bye bye, guys, and thank you for
Bye.
listening.
Cheers. Bye bye.